I'm Kyle with Fundamentals of Finance, and today I'll be covering quantitative easing and quantitative tightening, or QE and QT for short. By the way, I'm covering this topic because many of you asked me to. So if there's something else you're interested in that I haven't covered yet, please let me know in the comments. But on to QE and QT. Today's video will have three basic parts. First, I'll start by explaining what QE and QT are, since I know these are pretty opaque concepts that you most likely didn't learn about in school. Then I'll show you how they've been used in the past. And finally, we'll talk about some of the potential implications in the coming months since the Fed just restarted QT, or quantitative tightening, in mid-June 2022. I should mention up front that the QT program that just started is totally unprecedented. So you'll definitely want to stick around for the last part. But before I get too far ahead of myself, let's start with what the heck people mean when they say quantitative easing, or QE, and quantitative tightening, or QT. The first thing you need to understand is a basic concept of tightening and easing of financial conditions, which the Fed usually does by raising and lowering interest rates. Remember, one of the key ways that the Fed fights inflation is by raising interest rates to tighten financial conditions. When interest rates are higher, it costs more for businesses and consumers to borrow money. Eventually, that leads to falling demand, which lowers inflation. A simple way to remember this that I've used in a few previous videos is that you might say to your friend, sorry, I can't go to that concert. Money is tight right now. So raising interest rates tightens financial conditions, and lowering interest rates eases financial conditions. But what does the Fed do if they lower rates to zero like they did in 2008, but they still want to ease financial conditions more? Well, that's where quantitative easing, or QE, came in. In March 2009, the Fed started buying a lot of longer-term bonds to lower interest rates. Remember, with bonds, actually with pretty much everything, it always comes back to supply and demand. You had a massive new buyer of treasury and mortgage bonds in 2009, and all that buying activity made bond prices go up. When bond prices go up, yields go down. So whereas the raising or lowering the Fed funds rate, aka the ultra short-term rate that banks lend to each other overnight, mostly impacts short-term interest rates, QE, where the Fed is buying a lot of longer-term bonds, mostly impacts longer-term interest rates. By the way, are you ready for a light bulb moment? When people say the Fed is printing money, this is one way they do that, although it doesn't actually involve any literal printing. The Fed effectively creates or prints money to buy the bonds. Who do they buy them from? Often from banks that own a lot of them. So newly created money then goes onto banks' balance sheets and then can be lent out to businesses or consumers for cars, mortgages, or whatever. Money that did not previously exist goes into the financial system. Quantitative tightening, or QT, is the opposite of that. And that's what people fear so much. What happens when the money goes back out of the system? We'll get deeper into that in our third section. But for now, the way that it works is that the Fed can either sell treasury bonds or just simply let them mature without buying another one to replace it. Remember, bonds have an expiration date. You lend out money, collect interest for a while, and then get your money back at a predetermined date. If the Fed owns a bond and it matures, then they own one less bond. Whoever issued the bond pays them their money back, and then that money is no longer in the system. So to sum up QE and QT, QE is the Fed buying bonds, which lowers interest rates and puts money into the system. QT is the Fed selling bonds or just letting them mature, which raises long-term interest rates and takes money out of the system. Really, they're just different ways to ease or tighten financial conditions instead of, or in addition to, raising or lowering interest rates, which refers to the Fed funds rate, by the way. Now, QE doesn't have a very long history, and QT has an even shorter one. I already mentioned that QE was first used in the US in 2009, and that it essentially marked the bottom of the market and the beginning of the recovery from the great financial crisis. It had been used before that by Japan, but we'll focus on how it's been used in the US today. Part of the motivation for lowering interest rates on long-term bonds, besides simply making it cheaper for businesses and consumers to borrow money, was that it also made it less appealing for investors to park money in safe assets like treasury bonds. Because of course, with lower rates, they weren't earning as much anymore. By making it less attractive to hold safe investments, they hope to make it more attractive to buy riskier investments, which no one really wanted in early 2009. It worked beautifully and marked the end of the financial crisis. By the time QE ended in October 2014, the Fed's balance sheet had increased about 5x from 900 billion to 4.5 trillion. A lot of people thought this would lead to a surge in inflation, but it didn't happen because a lot of the money didn't get into the real economy. It just sat on banks' balance sheets. Remember, banks were at the center of the '08 financial crisis. They'd just been burned by lending to people they shouldn't have, and they'd also been hit with tighter regulations that forced them to hold more safe assets on their balance sheet for every dollar they lent out. So all that money that supposedly went into the system really didn't go into the system. Contrast that with 2020, when banks were not in a crisis, there were no new regulations, and QE was accompanied by massive fiscal stimulus, aka government spending, and you can see what happened to money supply. M1, money supply, is essentially the amount of money floating around in the system in readily available forms like cash and checking accounts. All that money didn't lead to inflation right away, since people couldn't necessarily spend it how they wanted. Maybe they bought crypto or GameStop or the ARK Innovation ETF or the FANG stocks, all of which went up a ton as Novus investors piled in, and all of which have come crashing back down. A good reason to be careful about where you get your investment information, and a good example of one of the criticisms of QE, which is it can lead to asset bubbles. But now with the 20 to 60% of the money people have left, they're selling out of those things and spending money on bars, restaurants, and travel again, the real economy. There's a big reason for the surge in inflation this year in the US. Yes, food and energy prices and supply chain issues have all had impacts, but excess demand is a big part of it, and that came partly from QE. But what about QT? Well, we just started that for the second time. It was done once before in 2018, 2019, and there were no major adverse consequences worth mentioning. But that was on a smaller scale, and they had to stop it in less than a year. So that brings us to today. The Fed announced that they would start QT in June 2022, reducing the size of their balance sheet by $47.5 billion per month for 3 months, and then increasing the pace to $95 billion per month thereafter. For simple math, they have about $9 trillion in assets, so that would be a reduction of about $1.5 billion by the end of 2023, which is estimated to be the equivalent of another 75 to 100 basis points of rate hikes, at a time when the Fed funds rate is already expected to rise over 3% by then. According to Goldman Sachs, financial conditions had already tightened rapidly to their tightest levels since '09. And this chart is as of March. So while this level of QT is unprecedented and no one really knows what the impact will be, here's how I think about it. QT is essentially the opposite of QE. It means taking money out of the system, placing upward pressure on long-term interest rates, and making safe assets like bonds more attractive going forward and risky assets less attractive. If QE marked the bottom of the market in '09 and 2020, and now we're doing the opposite, I probably don't need to tell you that this is not good for stocks or bonds in the short term. But longer term, higher interest rates actually lead to higher returns for bond investors. And QT should also help bring down inflation, meaning higher real rates. The real rate is just the interest rate you earn minus inflation. So if your bond pays you 4% and inflation is 3%, your real or inflation adjusted return is 1%. For more on how rising rates can be good for bond investors in the long run, please be sure to check out my video on that very subject. I'll put it up here in the corner somewhere. For stocks, this is also likely to be a negative in the short run, especially with everything else that's going on right now. However, if some combination of QT plus rising rates, gas prices, and food prices does start to hurt the real economy through lost jobs, which it most likely will, then at some point the Fed will start to reverse course. Like I said in my video on investing during recessions, what's already priced in is really important, and it's hard to invest based on short-term expectations. Do I think there could be downside in the equity market in the coming months? Yes, but there are 2 reasons why I'm not selling my equities. First, it always feels worst when the market is at its bottom. In hindsight, we can always look back and say, yeah, duh, of course, that was a catalyst for a turnaround. But at the moment, you never know what it is. We're already in a bear market, so while I don't know where this ends, I do know that a lot of the downside has already happened. And second, while I think there could be more downside in the coming months, my confidence level in that is pretty low. Hence my first point that it always feels worst at the bottom, and it's hard to predict the market in the short term. Conversely, my confidence level in the stock market being higher a few years from now is extremely high. Since stocks are long-term investments, it's pretty much impossible to predict short-term moves, and I'm highly confident in the long-term outlook from here. It makes sense for me to stay invested. This is not advice, of course, since I don't know your situation, but for me and my money that's invested for my long-term goals, that's how I'm thinking about it. I hope this helps give you a deeper understanding of QE and QT, as well as how I'm thinking about this complicated and unprecedented situation from an investment perspective. As always, if you have a question I didn't answer, or there's another subject you'd like me to cover, please let me know in the comments section. If you want to learn to invest like a professional, check out my free webinar below called The 9 Habits of Successful Investors. The link is in the description. Thank you for watching, and I will see you in the next video.